Welcome to the Xceptional Insights podcast. I'm Sean Wargo, and I'm joined by my colleague, Peter Hansen.
Hello.
Together, we make up the market intelligence team here at Avixa,
where it's our job to identify trends in the economy and understand how they affect our industry, the professional audiovisual industry.
Hello, this is Sean Wargo and Peter Hansen from Avixa, back with our Xceptional Insights podcast. It's that time of the year where we start looking back at our IOTA forecast that's put out in June and start to wonder, how are we doing? How are things looking? So we've put together some facts and figures, collecting data to kind of gauge that pulse. We're going to talk a little bit today about moving beyond recession that we talked about last time into kind of industry impacts for 2024. Where's there over and under? Where are we strength and weakness, all that sort of stuff. Where we're going to start, as always, Peter, is give us a lay of the land. What's the macro situation? What's the context for us for Pro AV?
Really exciting that we have this new update, something that we wanted to do for a long time. Take IOTA and make sure that it stays more current throughout the year, because you put all this effort into making these forecasts and you do your best, and then the market surprises you. And the market has surprised, I think, a lot of forecasters in second half of 2024. It's not surprising that the economy is cooling. We talked about recession risk. We talked about what the Federal Reserve Board's been doing with the brakes on the economy to get inflation under control. The brakes were on the economy. They were slowing it down. They did a reasonable job at slowing it down while not creating recession yet. But the fact of the matter is that we haven't quite pulled out of the dive. The dive sounds too negative. They pulled out of this downward trajectory towards a calmer, steady state economy, which we thought was happening late 2024. That was kind of maybe the consensus forecast, not just Avixa, but sort of economics profession in general, seeing that the post-pandemic, post-recovery craziness, apply the brakes, steady things out, and then to 2024, we're comfortable. Growth rates are settling into long-term norms, and that hasn't quite happened. The macro environment has been slow. There's a couple ways to see it. One way to see it is in the Federal Reserve Board's decision to make bigger rate cuts. They do that because they're looking at the overall data, thinking about their mandate of full employment, saying like, we've actually slowed the economy enough that there's now some risk to full employment. It's not that the economy's bad. It's not where we have bad employment right now. In fact, the more recent data that came out since that decision was good. But they just see some risk. When you draw the bell curve, that bell curve never overlaps more with some concerning territory. That's why we talked about recession last time. And the overall macro environment is now creating, well, I won't say headwind because it's not a headwind. What it is a lack of the sort of normal, healthy tailwind for Pro AV that we expect in a normal time. And we knew it wasn't going to be as strong in 2024. That's actually why, if you look at the IOTA numbers that we produced, there's a bit of a saddle effect where 2024 growth is not as good as 2025 growth. We know that these economic challenges exist, but they've just been a little bit tougher. Maybe a little bit longer lasting, maybe extending farther in time into this late 2024 period, potentially into 2025 some. And so that's creating some need to push and pull on the IOTA forecasts to get them right, to really, for all those users out there who are getting into the numbers, figuring out their SAM, understanding their market share, understanding their performance. What's accurate? Like what is really they should be comparing to? So, Sean, to pass back to you, tell us about those edits. Like how are we seeing the numbers evolve in light of this slightly disappointing kind of overall environment?
Yeah, sure. I think the story that you would look at is when we were, for the past several years, we've been talking about robust growth from recovery. We had supply chain challenges, but demand was still fairly healthy. It was just perhaps hard to manage because capacity had been hit during the supply chain challenges. That kind of worked its way through the system. But in 2024, I like what you're saying kind of about this maybe persistence of economic headwind / challenge kind of impediments to more robust growth. You're starting to see that really play itself out in Pro AV as well. So what that means, as you noted, saddle effect for 2024, we had already pulled back in the 24 version of IOTA to show a lower growth rate for 2024. We pulled about 8%, 8.8 out of 2023, about 6.6 out of 2024, and then 2025 looked good. The bad news is, as we look at the figures again, that persistence that you're talking about is resulting in further conservativeness. So to put a number on it, we thought that 2024 was about a 6.1% growth for all things Pro AV, all inclusive, all categories, all solutions, the net total of regional results. That is now looking like about 0.5% too optimistic. So we may end up, if we were to redo IOTA right now, which is not really the purpose, but is to give guidance on IOTA as it looks today. As if you're interpreting the results, how might you apply an adjustment to it? So about 0.5 point percentage off of 2024. 2025, I think, still looks pretty good as we come out of some of these challenges. I think as those decisions by Fed to lower interest rates, not just U.S., but in other economies, that starts to actually have an impact. We do think you start to see demand come back a little bit, and that's the key. So then it becomes a story of sectors, and where are we particularly more challenged than in other areas? I think where there's a lingering sort of supply chain issue because demand came down over the last year is in displays. You see some fundamental weakness there where it's impacting the revenue growth because price points have come down pretty substantially on displays as that market sort of adjusts to demand levels against capacity. This is classic issues for the display market and is still present with us. The good news for the end user, of course, that means displays are less expensive. And so you could think about a volume play in that category. But net, we think that pulls down on displays, which impacts things like digital signage. Digital signage revenue growth looks a little more suppressed in the current year, maybe releasing in the future. The other that's been interesting also you could argue in some ways an oversupply situation was conference and collaboration as a key solution area for us. We've talked a lot about, you and I, the return to office and kind of what that looks like now and how that looks a little bit more like a volume story, partially because the driver for that market has been scalability. Let's get lots of conference rooms kitted out as quickly as you can with cost-effective, modular, easy to use, plug-and-play type devices, often at a lower price point. And so you see that impacting conferencing as well. We're pulling back on the net expected growth for 24, I think in combination between a bit of hedging on the part of corporate to not necessarily buy as robustly and instead emphasize volume over value, over high end, that kind of thing. So those are two real bellwethers for us. Digital signage is perhaps a newer opportunity for Pro AV, traditionally speaking, and corporate or conference and collaboration as a core bellwether part of the market, really obviously having an impact. How about you? Where are you kind of seeing that, kind of linking back even to some of the macro stuff? Where's there weakness that you're seeing?
Yeah, I think it is quite interesting, especially being a bit out from the pandemic, to kind of think about, okay, I talked about overall GDP, struggling a little bit. Well, we're still long-term optimistic. We're going to get normal growth, like 2025, hopefully, probably, maybe it'll be like a quarter or two into 2025 when we're feeling healthy again. I think you really do see that with corporate where there's it's just this uncertain market. And without a good macroeconomic environment where the businesses are all feeling I feel good, they're very hesitant to invest in office space because of all the uncertainty that everybody knows about what the right volume is, what the ROI is, and so on. But I think there's a few other components of the economy that yeah, we're just still learning a little bit more about. I'll give you an example. We always felt confident about the return of travel. People are going to want to travel again. That's mostly true. But one of the things that you realize kind of when you've spent a while with the recovery data is not all travel is equal. So there's domestic travel, there's international travel, and there's also critically business travel. And actually, each through these three categories has some pretty meaningful differences. Domestic travel really came back strongly. That was the first travel that everyone was like, all right, I'm willing to travel, but maybe I'm not going to threaten a border yet. And international travel, that's actually been pushed around a bit by currencies, and then some travel to and from China has been something that, for example, has declined a bit because of strict border laws there. Japan as well, another place where travel to from has been a little bit altered. Then business travel, on the other hand, though, is something that has come back. We know it's come back, but it's just come back to a lower level. I think latest numbers, something like 90% of 2019 levels for business travel. And that's even a little bit lower than you think, because you think 90%, that's pretty high. But we're now in a bigger economy than we were in 2019. We're 5 years on. We should be at 110% of that, or 105% at least, so we're at 90. So why is that so much lower? Well, it's been through the ringer in the same way that we can now do remote work. Business travel can happen remotely. It's great, salesperson, get in person. It's clear that that's vital. But what about those peripheral calls? Can we do a little follow-up via Zoom, or let's meet maybe a little bit more frequently, and instead of having the day where the client comes on site once a quarter, we have monthly calls and the client comes on site once a year. Little tweaks like that. Another one, in the trade show environment, something we heard pretty clearly, I hear from other trade show providers too, is maybe trade show attendance numbers are not quite as robust as they were. We're only barely back. But a lot of exhibitors are happy because these companies, they're not sending all 50 staff. They're picking a subset of the staff, but it's the key staff. There's little pieces where they've been a little bit more conservative, and you're seeing that in travel. You're seeing that translate through to hospitality. Another one is retail. We always knew retail was going to come back to a meaningful level, and it has. But online retail gained ground in the pandemic. In-person retail is coming back. It's still experiential. It still has to provide that value add. There's certain parts, like malls, for example, they're really struggling. Now, more distributed retail is doing pretty well. That's actually quite a strong portion of commercial real estate. But it's these little pieces that aren't quite equal, and we've seen that actually in the update numbers. Retail is one of the sectors that's having maybe a bit more downward adjustment, and part of that is the digital signage story. Mm-hmm. Digital signage is a big driver in retail. Those prices come down, and the end users happily get more for less. Mm-hmm. So good for them. But it's little stories like that are adding to it. And one more I'll give you, that it's kind of counter the story that you hear, like performance entertainment, it's the big grower. And you know what? It still is. But that actually took a little bit of a haircut. And what you're seeing there too is there was this big kind of pent up demand, and not even just demand from like consumers to get back and go to our favorite concerts, but a lot of those touring artists were like, can I go on tour and make my money, get my new album out there? And then they did. And now we're in a little bit of a dead zone, I think, after that. Like I've been looking through a lot of the data, and it's like 22, 23, really strong. And then it's like kind of like a flat and almost a little dip here and there, like depending on exactly which numbers you look at. It's not a full-on dip. And overall, for Pro AV, it's still the revenue increasing because those providers have been careful with their money in the aftermath. But when we're talking about what exactly is happening and how is our understanding of that happening overall, these little subtle changes, like travel came back, but business travel not to the same extent. Mm-hmm. And retail came back, but not so much malls. Some of the foot traffic places are a little weaker. And performance entertainment, these live events, in-person stuff, came back, but actually there's a little bit of a maybe bullwhip effect after like the craziness of 2023 $1 billion Taylor Swift tours, and now there's not an active $1 billion tour, but like we're going to get back to more normal times. So it's complicated, and it's creating some fine-tooth adjustments and some challenges for people where it's like the expectation was really strong, and then the performance is strong, not
Right.
really strong.
Yeah, you could say that maybe the party's not over, but the party's quieting down a little bit, especially from that super event perspective that you're talking about. I think I would add to what you're saying, especially as we look at retail hospitality, the contribution or the effect of the China slowdown too is very pronounced there, right? When China had been going through a rapid growth period. What comes along with that is a burgeoning middle class who also are out in the market spending. They're going into retail, they're traveling, hospitality, all that sort of stuff. So as you see some of those segments slow from an Asia Pacific perspective, most notably China, that has that carryover effect. So some of the result that you would notice in our mid-cycle kind of guidance document is the effect of a slower China. Yes, India sort of picks up some of the slack by their more robust growth, but as such an engine of growth, I would point to China. Would you agree there is somewhat of a China effect?
Yeah, absolutely. And another layer I would add to that is that as China has run into these economic challenges, the government response has been quite different from a standard Western response to economic weakness. The Western response is boost aggregate demand. Like, let's do some government spending to make the overall buying levels higher. The way Xi Jinping has responded is to really double down on the aggregate supply side. Let's get us producing even more, really doubling down on that aspect of the economy. And so when you draw the line through, what does that mean for Pro AV? It means production is up. And that's where you start to get where are most displays manufactured? That starts in China. And when they start to have a bit more extra support for production there, and the incentives are for production to happen there, you're boosting this kind of global aggregate supply. And what does that mean for equilibrium price? It goes down. And what does that mean for total revenue for our industry? It goes down a little bit. It's not huge effects. These aren't, the Chinese government isn't doing anything crazy in terms of steps to prop up the economy. They're a little bit more piecemeals. Piecemeals may be a fair term. It maybe undersells it just a little bit. They're taking meaningful steps, but they're supply focused, not demand focused. So they're not doing any favors in terms of tenths of percentage points adding or subtracting. They're more towards subtracting on the overall revenue number. Although I'll just note, it's where you can start to tease out what is good for the industry, what's bad for the industry, what's inflation, what's deflation. The real product, the real product in terms of total screens and quality screens might be up, but the total dollar value is down. So that's kind of a deflation story there. It's just something I'll note as we talk about exact numbers.
One could say that the decline in display pricing might create a bit of more of a volume opportunity for digital signage. I mean, I would certainly argue, as I think most who follow the digital signage space, that part of why we are able to see signage proliferation, whether in venues and retail and hospitality, anywhere you go, transportation hubs, that kind of thing, is partially fueled by display price decreases because you can put more displays in more places. What that does is create an opportunity, I think, in the balance sheet a little bit for a solution area. So as displays become less expensive, a venue might put in more, but then allow some of that budget to be reallocated to a back-end content management system, more integration, larger displays, a whole bunch of different things start to happen in that environment to what make me and why we sort of stay long-term optimistic about digital signage as also an area of growth for Pro AV, a little bit above average for that category of solution. I think what props that up, even as we take a haircut off of it because of display prices, is a bit of a shift in the opportunity. So the challenge, opportunity to our marketplace is how do you leverage that affordability on displays to potentially up your game, add a little bit more margin? Maybe you're starting to think, managed service offerings in terms of content, refresh cycle, maintenance, all the things that allow you to prop up on the revenue side, on the long-term revenue side and the margin side. I think that also exists in corporate. So the counterpoint to the conference and collaboration, shift to more scale and volume there would also be, we've talked about before, kind of managed service offerings in the same regard. I would just say I'm a bit more optimistic about that opportunity on a digital signage side, just because of the nature of how that technology is utilized by venues and such to differentiate their experience, to amp it up, to augment essentially what an audience member might be experiencing when they go to a stadium, et cetera. So just pointing to that as, while these things happen in our marketplace, we also are seeing corollary kind of opportunity for perhaps the balance sheet to shift a little bit into a service offering. So a way we get around that. Any other kind of, what's the way to put it? Maybe emerging opportunities that come from what might look like a challenging landscape as we kind of wrap up today.
Yeah, I'd really double down on your point about, you say like, okay, if there's less money spent on displays, what that frees up some budget. Or I'd say like, if there's less money spent on displays, they buy more displays, they need more content. They need more servicing. So I think about when you see a story of like a price point decline, I think what you should be thinking is, how will that, how can I take advantage of the volume implications of that? Like, can I service them? How can I help a company get more out of the additional displays they're going to buy, or the additional projectors if price is going down, if the additional speakers if price is going down, whatever it is, like China's trying to produce more. So equilibrium prices are going down, like we have inflation under control. This environment is changing, and that's going to cause end users with prices lower to buy more. That's as simple as it gets. How can you take advantage of that? I think that's got to be I think it needs to be like an important part, because we've like almost got a little away from, I think in the past couple of years, where like prices were going up. It's just a different environment. And now we're going to be in maybe a little bit of like a supply slightly ahead of demand environment. Prices a little bit low. Industry cannibalizing margin, especially on hardware. So thinking about like, okay, let's put aside as much as possible like margin on hardware. It's like, I'm not going to bank on making a bunch of margin of reselling hardware. If you're a distributor, integrator, whatever, like, how can I add value to my end users through service, through as a service, like not through service, like being a service provider, like design, whatever, but also like as a service, like, okay, like it's easier to maintain like a conference room because the refresh cycle is cheaper because the hardware is cheaper. So I can create an as a service conference room in a more attractive pricing model and have a bigger value add as a company there. Mm-hmm. Just oversimplified, but that's the kind of, I think, mentality you need to have when you're dealing with this. Like, the economy's not so strong, supply is leading demand, especially some key categories. Therefore, margins are squeezed. That's where you look for opportunity. Yeah,
seemingly strange conversation to be having in what we had gotten used to be an inflationary market, right? Yeah. Things getting more expensive. In Pro AV, often the story with technology is actually things net deflate because you add capability, features, specification over time. One of the points I would underline that we've talked about a lot as a driver for our overall industry is not forgetting that we are still part of what we're defining as an experience economy. So that service component, that value proposition, to me is, how do we think about technology as a part of that experience economy? Or put another way, how do we consider technology as a part of the brand identity that companies are utilizing? They utilize technology in part to make a statement about their brand and experience. So that remains a key area of growth for our industry, a key provider of opportunity. And what, as you look at the overall, like as I mentioned in the beginning, going from a 6.1 down to a 5.6, the reason why you stay at the 5.6% average growth rate is you still have these outside opportunities that are really propping it. It comes down to the experience economy, I think. As always, been a great and useful conversation. Join with us next time as we probably dig more into the experience economy, take another look at the driving trends for Pro AV. Until that time, it's been Peter and Sean from Avixa. Be safe and be well.